Well, a common question I get asked about the first or second day of class is what is the difference between expenses and liabilities? Because they are seem like they're similar. So first of all, let's start off with a definition. Expenses are money that you spend or cost that you incur on something to generate revenues. These are things that end up on the income statement and they lower your net income. That's what expenses do. And liabilities are something you owe. It's a debt or some type of financial obligation. But let's not stop there because everything in this class is all going to be focused on how does this affect or what's going on with your accounting equation. So let's take a look at that. So here's our accounting equation. Assets equal liabilities plus owner's equity. Now, what we're trying to figure out here is the difference between a liability and an expense. Well, a liability is one of these three elements of the accounting equation. There's only three elements in the accounting equation: assets, liabilities, and owner's equity. And they've got to equal at all times. That is, the left side, the asset side, has to always equal the liability plus owner's equity side. So liabilities are one of the three elements of this accounting equation. Now, an expense, on the other hand, is part of the owner's equity. It is one of the four things that will change owner's equity. For example, there's only four things that change owner's equity: investment by the owner, revenues by the business, expenses, and they reduce owner's equity, and withdrawals by the owner. That is when the owner takes money or equipment or something out of the business. That's just the opposite of investments. But anyway, all we're going to focus on is our expenses. And again, expenses lower owner's equity. So let's do a transaction. Let's borrow $4,000 to buy a car. If we do that, then assets are going to increase, and the assets is going to go up as a car. And it's going to go up by $4,000. And then we're going to have a liability. We're going to have this obligation to pay for this car, and we're going to put this on a note. And because we're assuming that nobody's going to let us borrow money unless they charge us interest. So we've got asset side on the left, $4,000 going up, and we got liabilities on the right side, $4,000 going up. And keep in mind that our accounting equation is still in balance. Now, let's make a car payment of $400. And let's say that in the real world, most of that $400 is going to be interest. Let's just say $300. So if that's the case, $400 car payment, $300 of it is interest. So here's what happens. Assets under cash will go down $400 because that's what we're making the payment for. The notes payable is only going to go down to $100. That is, our liability will be affected by $100 because it's going to be $300 worth of interest, and so only $100 of that $400 payment is going to go towards the principal. So there's $100 right there reducing liabilities, and then what we have left is $300 that goes to interest expense. I didn't put out the word interest here, but it's under expense, under interest expense. Now, let's look and see what happened. Asset side went down $400, and the liability owner's equity side went down $400. And I'm hoping you're seeing now there is a difference between what this liability is, which is one of these three elements, and how it affects this situation, and what this expense does, and it really only affects owner's equity. Okay, let's take a look at something else here. We have, let's say we receive in the mail a $500 utility bill from OMU for electricity that we've already used. We've already used this electricity last month sometime. When we get the bill, we got to pay for it. So when we get the bill, the first thing we're supposed to do before we pay for it in the accounting class, and really in the real world too, in accounting, in a business situation, is we record this $500 that we have here, this bill, as a liability. And notice it's a liability right here, and over here it's also an expense. So look what's happened. Nothing's changed on the asset side because we haven't paid the bill yet, and our liabilities go up $500, and owner's equity goes down $500 under the expenses. So we've had a plus $500 here, a minus $500 here, and where our accounting equation is staying in balance. Now, the next thing I'm going to ask you would be, what would happen to this accounting equation when we pay our bill, this $500? And I'll stop right there.